The founder and managing director of Valentis Advisors Private Limited. This is a portfolio management service registered by SEBI. Jyoti manages about $100 million over two funds. One is a small and mid cap product called Rising Stars Opportunity Fund, and of course, a multi cap fund. We'll share the details of this a little later. Before starting his own advisory, Jyoti was employed with the Bank of America Merrill Lynch for the past 21 years, and tracking the Nifty from its inception to its all-time high of about 20,000, and seeing the Sensex in low four digits to its 66,000 point level today. Mr. Jyotivardhan Jaipuria has seen it all. Jyoti, welcome to Business Today Television. It's such a pleasure to speak to you. Let's start very quickly. You were in Hong Kong recently and you met up with all your old friends from the foreign institutional fraternity. They are pouring money into India. Tell me the two or three views that they hold in common when they look at investing into India at these record levels.
So, Shell, it's like quite, there was a lot of commonality on views, which always worries me a bit. But in general, everybody said, Jyoti, you're in the right place. India is the place to be for the next few years because we think India is the fastest growing economy in the world. What's probably helping us is like a combination of a couple of factors. One is, China is like 25% of the MSCI emerging market. And there's a worry that, China is well past its peak now. And with such a large weight, most people are very uncomfortable with that weight. India's weight like was number two in the MSCI, it fell down to three. And so we are between two and three. So most people think that the big overweight should be India. It's a secular story for the next 4 5 years. Second is what is helping also is I guess geopolitically, you know, India is in the right spot. So people think, okay, India is like going to get benefit of, a lot of the friction between the US and China. And so India will be one big beneficiary. Last few years, mind you, we saw Vietnam be a big beneficiary of this. But
Yes.
now Vietnam is starting to, in some sense, it's a small country. So infrastructure will creak and there's only so much you can put in Vietnam. So, a lot of people now are looking at India as a bright spot. So in general, there was a lot of consensus that India is where you want to be longer term. At the same time, there's one concern only for people. Just get the market low, valuations are too expensive. We want to buy a
Yeah.
dip. And that's what I tell people. If everybody wants to buy the dip doesn't come because there's somebody who buys half a dip also now.
Right. So, Jyoti, of course, these are very good broader macro points. You are primarily a very well known stock picker on the bottom up approach. Tell us two or three things that you feel have changed dramatically in India, which have led us to this wonderful island of safety kind of a definition that a lot of your foreign friends are talking about, and of course this very very strong inflow that is also coming into domestic markets, either in PMS advisories such as yours or even in domestic mutual fund via monthly SIPs.
Yeah, so I would say, if you look at India for the last 20 years, and that's the thing with being old, you've seen a lot of these stuff. So, India generally has been a market where you want to play the consumption story. Well flagged demographics, consumer segment which has not taken loans and which is starting to take loans, etc., etc. At the same time, we've had this, it's an underbuilt infrastructure, but we never get our act together, we don't build it. But there's a period from 2003 to 8 where the whole boom was led just by infrastructure. So, you have
Yes.
infrastructure on one side, you have then consumption on the other. And the third has been this whole outsourcing story where tech stood out like 97 to 2000 was the dream run for the tech companies. And all three of these, in some sense, still exist. Like the whole outsourcing story has become very prominent. There's a China plus one now. There's a
Hmm.
Taiwan plus one, and now there's a China plus minus one. I don't know whether you've heard of China minus one, but that is getting very, very popular. So one is this story is picking up a lot. The other is, if you see the last 5 years, the capex story is picking up a lot, especially from the government point of view. So government capex as a percentage of GDP has gone up nearly 50%. It's gone from 1.2 to 1.8 from the budget if you just take standalone. The third is obviously the consumption story is good and it continues to be good. In fact, like I keep telling people that don't keep thinking of consumption as
Hmm.
soaps, shampoos, and toothpaste because that was
Absolutely.
like the 90s story. Now it is What does a consumer do when his income goes up from $2,500 per capita to $5,000 per capita? There'll be a different set of products. He'll buy more houses, more holidays, better
Yeah,
houses. I want to paint my house. I want to,
absolutely.
have better tiles, etc., etc.
So basically, instead of buying, soaps and detergents, people are now looking at Gucci bags and Jimmy Choo shoes, especially out of India. That's the dramatic shift that's happened. Okay, Jyoti, now we'll get to basic brass tacks. Let me first share with our viewers the kind of performance that Valentis Advisors has put in. Remember, Jyoti manages about $100 million over two funds. One fund is Valentis Rising Star Opportunity Portfolio. Since inception, this fund has compounded at about 19% per annum, and over the last 3 years, each year the CAGR has been about 51%. It's primarily composed of small and mid cap counters. Mr. Jyotivardhan specializes in research and therefore buys stocks which multiply over the long term. The other fund is the multi cap fund, where the CAGR has been better, 21.4%. Now, with this background, let's begin our thesis on where Mr. Jaipuria finds value at these levels. Since you've been primarily a stock picker in the small cap and the large cap space, Jyoti, these are difficult times because finding value has become increasingly difficult. Both the small and the large cap indices are at record highs. What is on your radar, and where exactly do you find consistent value in a particular sector or across a certain kind of market cap?
Yeah, so Shell, we have like a strange philosophy. We generally try to do stuff which is not in favor. Most of the time, like
Yes.
we are buying stuff which is not in favor. So we have what I call a three use philosophy. We buy, of course, undervalued stocks, but we also keep looking for stocks which are underowned and which are undiscovered and try and move around in that space. So we were very early into this whole capital good game. We were very early into, buying stuff related to capital good. And that what helped our performance for the last 3 years doing very well. In the last few months, what we've been incrementally getting very positive about, and now the last 2 day results are bearing it out, has been the pharma pack. So, we were very overweight pharma in the COVID period. We had reduced our pharma weight a year after that, saying that, we have peak earnings, they'll do badly. But pharma is something we've been very positive on. And for the last 3 months, I've been flagging it to everybody that our view is that the US generic market, after a long time, the US generic market is probably starting to plateau and bottom out. We've seen, like, for the last 5 years, prices have kept falling, people have done badly. And this is one market which is surprised now on the up more than on the down. All the people who are getting burned because, everything else was doing well, but
Yes.
US, they'll start to do very well. And, the last few days, the results which are coming out of all the pharma majors are bearing it out that, okay, this is one market where we probably can see a big turn happening.
Absolutely. Over the last 5 years, pharma has been an under-owned space. I completely agree with that sentiment. And Dr. Reddy's and Cipla coming up with fantastic earnings. That's lit a boom inside pharma stocks, some of them doing fairly strongly over the last 2 odd months. Jyoti, what are the other undervalued spaces that you see in the market, which are not exactly on strategists' radar, and you are able to buy stocks cheaply and in a quantity that you feel very comfortable with?
Yeah, so now to be fair, I think nothing is really, really undervalued. The markets are like, they're not cheap. They are probably on the expensive side. So from here, what you have to look at is, can earnings sizably grow? And so even if the valuation is correct at some point, can I make huge returns simply because over the next 3 years my earnings, goes up at a compounded 20 to 25% growth. And so that's why we are focusing a lot of our energy on. We want a 20% plus earnings growth. At the same time, valuation should be maybe not overvalued by a big margin, but maybe 5 to 10% overvalued. So that's the area we're looking at. We're still quite bullish on some of the smaller themes in the capital goods which we've been playing for some time. Like one of the things we've been playing a lot has been this whole Jal Jeevan Mission, Har Ghar Jal, which the Prime Minister had started. So pipes is something we bought in a big way. We continue to like the pipe story. So in pipes there's the PVC pipes and there's the metal pipes. The metal pipes is what we owned in a big way. I think the next couple of years will belong to the PVC pipe companies and they will do very well over there. there'll be a demand growth, and last year they had margin compression because of what was erosion of the prices and so inventory loss. That will get reversed and that will do well. So that's one segment which we are playing quite a bit now.
So that's a bit of a revelation that piping companies will do well. Normally, Mr. Jaipuria is very, very hesitant in taking names and talking deeply about sectors, but please do your own checks before getting into the piping story. The other interesting part in the market, Mr. Jaipuria, is the deep, deep value that's getting exploited and exploding in the PSU banking basket, and they fall exactly on your plate. Under ownership, a disdain for even the top brands there, and the fact that the market never liked this space over the last 5, 7, 10 years. Do they still offer value, or do you think the rally is done and dusted?
So, frankly, we caught this whole theme early. So it's not necessarily the PSU. The whole theme was that, for the last many years, the retail banks were favored and the corporate banks were avoided because, there were NPL pressure which was coming in. There was a big cleanup which was going on. So last year is when we said that, okay, most of the cleanup is over. So all the corporate banks will start to do well and retail banks will, relatively underperform the corporate banks. So we bought both the large caps as well as the small caps. Now, within that corporate banks, there's a public sector banks which have been cheap, but there's also been some of the private sector banks which have been equally cheap or even cheaper. In fact, even now when we look at our portfolio, we have a couple of private sector banks which are actually as cheap as the public sector banks or even cheaper, and they play the same story. They had a lot of pressure when the NPL provisioning was happening, and
Yes.
now that the NPL provisioning is behind us, you can see a good runway for growth over the next 2, 3 years. They'll be back into action in terms of growing their balance sheet. So that is one space which we have been playing in a big way, and we continue to like that space.
Okay, coming to both portfolios, if you look at the overall $100 million dollar pie, Mr. Jaipuria, how is it divided over sectors? Where are you overweight, and where do you think that it's done and dusted?
Yeah, so in fact, I'll give you three broad themes which we have. So one is, we've been more focused on domestic. So it has been played local and avoid global. And the reason for that has been just a lot of worries on where, the US goes, whether they go in a recession or not, they'll still see a slowdown. So it's now been, played domestic. Within domestic, we've been more focused on the investment theme rather than the consumption theme. And the reason for that is two, like I said at the beginning, that government has been spending more on capex, and that is helping investments. At the same time, the consumption stocks are still very expensive. So if you look at the whole basket, for me, consumer still is like the most expensive space.
Correct.
The third theme which we have been playing, which is a theme we've been playing since the beginning of this year, has been there were a lot of stocks which got hurt last year because the commodity prices went through the roof after the Ukraine-Russia war.
Yeah.
That stocks saw margins fall 300, 400 basis points because raw material went up. Now you're seeing a reversal of those commodity prices. So our call is over the next 2 years, we'll see a return back to those margins. We'll see a normalization of margins, and that will lead to a very good earnings growth and a good stock price return. So that's the third theme which we have been playing. So it's basically these three themes which we can keep splitting into sectors. So for example, if we take the third theme, there is the tile story which is there because gas prices have come down. There's some of these wire and cable which we've been playing. There've been cement. So if you see cement now, though the prices are not going up for cement, the EBITDA margins are going up simply because all the pet coke and the
Input
freight
costs.
costs have been going down.
Yes.
So
Okay. Okay.
that's the theme which is like across few sectors which you can play.
Okay. Coming back to the value that's getting, visibly, it's not exactly overpriced, but then, if you look at the defense space, we've seen some excellent run-ups in government PSUs. You think that's overrated, or you think, this was the time over the last 20, 25 years when these stocks had done pretty much nothing, but it's now getting re-rated as a part of a global understanding that some sectors should not lag for that extended a period?
So, I'll give you a macro thought and then a micro thought. So in terms of pure macro, defense looks very good. And the reason it looks good is I don't think our defense budget will go up most much. If you see, it just barely goes up in real terms. It goes up 4-5%. But the Indian companies will get a bigger and bigger share of that defense budget, which was never the case. The government, in a very conscious manner, is saying, "I want to indigenize. I want, the defense companies in India to start getting the benefit of these orders rather than, give it to international companies outside." And that is driven by two factors. It's driven first by the fact that you want India to grow, but at the same time, everybody realized that we should have self-reliance in critical things. So the pie is going to grow a lot. So what one can visibly see is from here to even 5 years later, the amount which will come to defense companies will be huge. It will be much larger. It probably will be double of the sort of orders you're getting just now. Now, coming to the micro part, the issue is it priced in already? And, how much is priced in? So to some extent, it is priced in. The easy part of the return is done. What is not priced in is that the companies deliver the growth we expect them to deliver, then you still make a lot of money. At the same time, with defense, there's always this is like the buyer is the government. And something happens, the government goes slow on it. So that then can bring valuations down very quickly. So what you have to be ready for is, okay, you're buying it for the longer term now. You are buying because you think 3-4 years later, the prices will go up a lot. But short term, there could be volatility. You could see these stocks fall 20% also if something goes wrong. The other thing is you have to be careful with the balance sheet of these companies, because a lot of time there are lots of orders from the government, but the payment terms are not exactly good, and so
Yes.
the more you grow, the more the balance sheet deteriorates. So those are the two things you have to keep in mind and look at stocks a little more individually, and then take a call. But in general, I would say it's a sector which for the next 5 years will be into quite a bit of fashion. It will grow much bigger than what it is today.
Well, that's very heartening to know. And we've already seen a lot of multi-baggers emerging from this PSU defense space. Let's hope the good times continue. Mr. Jaipuria, the other thing that happened over the last 2 years was this investment theme that came from the railway sector. Huge amount of money that the government poured in, and stocks have now started reacting after maybe an 18-month kind of a lag, because money from the government comes beyond a certain time only. Now, is this a secular story that you think is unfolding, just as we've seen a great amount of work already happened on the highway sector by the government? Ports and airports are done, but railways is something that's lagging over the last 30 years. Is this theme in front of your radar?
So it is. So again, it's like, just like I said for defense, it's the same theme that, the amount of orders which will come will be much, much larger. But, sometimes the orders don't come on time, sometimes they come. The other, like you mentioned, the highway theme. The highway was a great theme, right? But how you play it, and if you think of the EPC contractors, not many of them gave great returns to the investors because of the same
Yes.
issue that ultimately, like, you end up having to take care of the balance sheet. And so, when you don't get paid, you somewhere want to stop your growth. If you grow too fast, your balance sheet deteriorates a lot. So that's the one thing which we have to keep track of, that, okay, sometimes government underdelivers on its promise of orders, or sometimes they give the orders, but then, the actual implementation takes longer. So, your order book remains on paper and your sales conversion takes longer. But otherwise, in general, I would say a lot of these themes are themes which over the next few years will do well.
Okay, and we've talked, of all the good things that have happened in the markets over the last, year-to-date kind of a basis or 2-year basis. Tell me what worries you. We've seen such fantastic returns coming in. Of course, you book profit on a fairly regular basis, but what can go wrong?
Yeah, so one is like, if you put it in perspective, the returns are good in the last 4 months, but the
Yes.
returns are not spectacular. Because if you think of, you go back 2 years ago, it's not like we made some crazy return. Of course, at that time the markets were very, very highly valued, and that's the reason we not made returns. But in that sense, returns are not great. So what worries me first is the world. So we are a market which is in sync with the world. We can delink a bit, but we can't delink totally. So the world is like going to go through a slowdown for one. And so we will see a slower growth, even if we don't see the recession in the US. So everybody flagged never came, but still the growth is going to be slower. The second is the Fed. The Fed all this while was like, I will protect you. I'll cut rates. I'll, pump in liquidity. The Fed, we've suddenly seen inflation come, which we never expected. And even now, everybody says, okay, this was cyclical and it's getting over. But inflation may continue to be at least higher for longer. So very short term, I'm thinking, we'll probably hit the Fed uh, benchmark of 2% probably next year, and then we'll see rates starting to come down. But
Okay.
if you think of the next 2, 3 years, 5 years, we probably have inflation which may not go to zero, which we got used to. So the Fed
Absolutely.
may not be as positive for the markets as we've seen over the last 20 years, 30 years. So the Fed may be a little difficult place. The third is the valuations everywhere, like whether it's India, whether it's US, whether it's anywhere in the world, valuations are not cheap. We are buying stuff at a valuation which we justified it saying the interest rates are low, but interest rates are now gone up, but the valuations have not shrunk. The valuations still continue to low. So when you're buying stuff at this valuation, you'll probably make good returns, but you'll not make extraordinary returns. So, these are the three things which are basically broadly from the market point of view, what one has to remember.
Okay. And my final question to you, Mr. Jaipuria, are people coming to you with money bags and saying, manage money for us? Such is the drumbeat for earning money in this kind of a market that expectations have really gone awry. People want to double their money in a month, and especially this options market where you want to double your money by 12 o'clock noon. How are you speaking to clients and telling them that in equities, if you are able to compound at 17% CAGR, that's a stunning return? What are clients asking you, and how are you trying to sort of tamp down their hopes and expectations?
Yeah, so there's a mixed bag of clients. So we tend to deal with more like the family offices and the ultra high net worth people, where the good thing is there's a distinct shift where people are willing to do equities. They've seen like, the last, if I go back 15 years ago, people were just, no, I don't like equities, it's too volatile. Today, everybody is willing to do equities, whether it's the small man on the street or the ultra high net worth. And we see it in the flows, right? SIPs today are $1.5 billion a month, which has given us a great, uh, some sort of benchmark against the FI which goes down. The other is when we talk to investors, we say, first of all, like, if you don't have money which is 3 year, 5 year, don't come to us. Because we tend to think 3 year, 5 year, we don't think day to day, we don't even look at the markets every day. So we buy and hold, and it's a very boring strategy. Our churn ratio is like 16% or something, one of the lowest in
Yes.
the industry. So we tell people, if you are in sync with our thought process, come to us, because we don't change our style. And we don't change it when markets go down, we don't change it when the markets go up. And so, that is something which people tend to like understand. Okay, this is what you do. They all say, oh, you get more aggressive, take more risk and all. I said,
Yeah.
see, we want to get risk adjusted returns over a period of time. And we don't like these returns. The returns will come, and they'll come, at a fairly brisk pace. But then, don't get carried away with the bull market. Third is, we are telling people now that we'll invest very slowly. The markets have been
Yes.
very bullish. For us, it is we want to do an investment in a staggered manner rather than one day, because we think there may be chances where markets slip a break, then we should have money at that time.
Okay, that's all that we have time for, Mr. Jaipuria. It's been a lovely conversation spanning foreign friends, the US Fed, the defense space, the railways, and of course the PVC piping companies, where you are more bullish than all the other sectors put together. Thank you so much for your time. It's been
Thanks a
a
lot,
lovely
Jay.
conversation, and
Bye.
I hope we get you more often to get insights into this wonderful world of investing. Thank you for joining us.
Thank you. Bye.
That will be all, ladies and gentlemen, for this episode of the show, where we try and track equities in a manner where you can create a supernormal return by doing the least amount of effort and work, and remain glued to Business Today Television. Thank you, John, for joining us.
We are very happy that during Honorable Prime Minister's state visit to US, 3 major semiconductor agreements were signed First one is Micron Technologies. Very happy, and I thank Honorable Chief Minister of Gujarat. I thank Honorable Chief Minister of Gujarat for his very proactive approach. The land for setting up the unit was allocated within a few weeks. And as we speak today, the land development work is going on and the construction of the unit will start very soon. Second, applied materials, the most complex equipment which go into semiconductor manufacturing, they will be manufactured and designed in India.